I'm joined by Christoph Riniker, Head of Strategy Research at Bank Julius. Baer. Christoph, good morning. Thanks for joining us.
Good morning.
Christoph,
good morning.
Do you think there's a high chance the global economy could slip back into a double dip recession?
No, it's basically not our view. We think after the data we have seen on Friday, like non-farm payrolls figures, combined with ISM actually rolling over, that's correct, and bad consumer confidence data, but nevertheless on the other side better unemployment rate, that the economic growth path will remain bumpy going forward, but we don't think that it will fall back into a double dip recession.
But what sort of environment is this if you're wanting to make money in various asset classes?
Well, of course, it's difficult at the moment. When we look at equity investors, they price in a double dip. We can say that with valuations on current levels. The same is true for bond investors with 10-year government bond yields below 3% in the US. So the overall environment currently in the short term looks a bit shaky, but nevertheless we think that investors might be a bit too pessimistic and that we can have some sort of return anyway. So, but nevertheless, in the near term, this equity market pattern, this most probably will remain shaky, like having possible further setbacks. But nevertheless, overall, we think that markets can move more or less sideways with quite some volatility, and only towards year end that there might be better results and then better equity markets again. And so, of course, with such a scenario, it's better to stay, for example, with high quality stocks, and of course a very good topic very good topic is always high dividend strategies, of course.
The earnings season is about to kick into full gear. Christoph, do you think that might have potential to give equity markets a little bit of a fillip?
Well, we have now seen in the past several quarters of quite good quarterly earnings. Now for the second quarter, we think that we might see some pressure. So for the US, we go for -2% on a quarter-on-quarter basis. In Europe, for something like -4%. But when you put this again into perspective with leading indicators rolling over and also earnings revisions, which are on very high levels, actually, it seems, at least it seems to be normal that we have some pressure in earnings. But of course, for example, in Europe, that we have slower earnings or a bigger decline there in quarterly earnings, of course, might have some influence from the sovereign debt crisis.
Very quickly, Christoph, these markets are exceptionally volatile. I mean, what's the best way of investing within such volatility?
Well, normally, of course, with high volatility and quite pessimistic investor sentiment, on the one hand, you can say there are possibilities for like buying opportunities when markets are quite low. And when you take like backtesting measures, you see that these should be good markets. But as I said before, in the very short term, remaining cautious. Then you probably would rather go more for defensive stocks, for example.